Hello, traders. Gary Wagner here. It is 11:51 in Honolulu, 5:51 in New York on Monday, 12th day of September 2022, and this is the Daily Report for gold and silver. An interesting start to the week in the financial markets with the Bureau of Labor Statistics getting ready to release the CPI inflation report for August tomorrow. We saw nice rises in the precious metals markets and a decline in both the dollar and yields in U.S. debt instruments. First to gold. Gold, basis the most active December contract, is currently fixed at $1,735.40, a net gain of $6.80 or 0.39%. The dollar had a decline of approximately 0.65%. It is the third consecutive day in which we have seen lower lows, lower highs, and lower closes after the dollar hit a peak or a top above 110 last week. Currently, we have the dollar index fixed at 108.285. And lastly, a phenomenal showing in silver today, gaining 5.34%. You can see that as it relates to this large green candle on our daily chart, with September silver futures currently fixed at $19.77 after factoring in an increase of $1 per ounce. As you know, the dollar has been an extremely critical component of changes in both gold and silver pricing, with the dollar declining for the last 4 consecutive trading days after hitting a top last week. We're looking at a daily chart of the dollar index, and you can see that in the middle of last week, we hit the highest price that we have seen in over 20 years, coming just shy of 111, coming in at approximately 110.75. However, even though we saw the highest value in the dollar index last Wednesday, it must be noted that it opened above Tuesday's close, as represented by the open here and closing price here, but closed below the closing price on Tuesday. What followed on Thursday, Friday, as well as today, was 3 consecutive days in which the dollar traded to a lower low than the previous day, as well as a lower high and a lower close, taking the dollar to 108.285. While it is still above the 50-day moving average, it must be noted that we have seen a substantial decline in dollar value, and that has been highly supportive of the precious metals, which brings us to our analysis on gold. We are looking at a daily gold chart. We are currently trading overseas in Australia, and as you can see, currently we have gold fixed at $1,735.90, a slight decline from the close in New York, as well as the high that came in at approximately $1,744. The fact that the dollar hit a peak last week and then began to decline could not have come at a better time as it relates to gold pricing. The one thing that is most noteworthy is the fact that the area of $1,710, which of course is reflected as the 78% Fibonacci retracement, held eloquently, which was something that we were extremely concerned about because we believe that there was strong major support between 1700, a key psychological level, and 1710, a level that is Fibonacci based, that gold really needed to hold, because if it did not, our feeling was it would most absolutely test 1680. And as you know from articles last week, that is really my line in the sand. However, gold effectively held that price point, has moved above it. And in terms of what we're looking at now, our real level of solid resistance comes in at approximately $1,750 to $1,751, and that is based on, first, the 50% retracement. It's not a Fibonacci retracement, as well as the fact that that lines up precisely with gold's 50-day moving average. Now, gold is still in a full bearish alignment. And to illustrate that, I have just put up the 200 and 100-day moving averages. Of course, the 50-day was already on the screen. And to be in a full bearish alignment, the lowest value moving average of the three would be the shortest time sequence, the 50-day. Above that would be the 100-day, and above that would be the 200-day. Although gold is in a full bearish scenario, as we just talked about, there is one interesting facet that we need to look at and see if it results in a key reversal of market sentiment. And that is as follows. We're looking at a much longer term view starting at March, when gold hit this year's record high, 2,077. And what followed was a series of lower highs, with the last high coming in at roughly $1,825. At the same time, we have seen a series of lower lows, and we had this low that came in at the end of July at 1680. However, now that we've had a slight uptick in gold, meaning it held 1710 and 1700 last week, this in fact could be the low that we see. And if this rally actually builds up some steam and develops into a real rally, it will be one of the first times we have seen gold actually have a higher low than the previous low when we compare it to the low at the end of July to this low in September. However, for that to complete the cycle, to really signify on a technical basis that we've got some sort of a key reversal, we would need to see this rally move above $1,825, because that would mean that not only did we get a higher low, but we also got a higher high, and that would be extremely bullish for gold. A phenomenal day for silver today, as I said, gaining $1 or over 5%. And what is most interesting about what we're witnessing is that it got a double lift, the lift that gold got from weaker U.S. dollar and yields, but also a strong move in U.S. equities because of the industrial component of silver and the recent passage of the Biden initiative, which includes clean energy and therefore solar power. Right now, it seems as though silver closed just above a former resistance level that could become support at 1978 per ounce. That is the 23.6% fib retracement. It also just barreled through the 50-day moving average, and that occurs at 1919. While it still is in absolute bearish alignment, it must be noted that this kind of strength puts us in a scenario where we believe that silver could easily move as high as $21.25, the 38.2% fib retracement. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow following the release of the CPI inflation report for August. Bye-bye.